Real estate investing is one of the most popular strategies for growing one's wealth. Combined with the enticement of generating cash flow and appreciation of the asset, it opens up a treasure chest of tax advantages that other investments just can't offer. Uncle Sam can become an investor's best friend as there are many investment property tax benefits available. The trick, however, is understanding what's available and how to capitalize on it. Often investors strictly pay attention to the cap rate of the property when deciding to purchase, without considering the additional tax benefits that may be available. Depreciation of real property is a tax-saving strategy. Depreciation allows you to recover the cost of certain aspects of real property over time in the form of a tax deduction. The IRS defines depreciation as the process of recovering an asset's acquisition cost until the asset is recovered. Real estate depreciation is an important aspect of real estate management that allows for depreciation to be offset against the property's income, thus reducing the tax due. It is commonly referred to as a phantom expense, since no actual check is written or disbursement made to cover the expense. Among other things to qualify for depreciation, the property must be a property used for investment. If used personally and as an investment, the depreciation will only be applicable to the portion of the property used for investment. You can depreciate the costs associated with the initial purchase of the improvements on the property, as well as the improvements made to the property after the purchase. An improvement to the property can be defined as anything that increases the value or usefulness of the property, adapts the property to a new use, or restores the property to a better condition. The theory behind depreciation is the improvements on the property's decline in value because of wear and use over time. The land itself does not qualify for depreciation. Depreciation starts when a property is put in service, and you can continue to depreciate the property until you have depreciated your entire depreciable value in the property or until you retire the property from service. Property is considered retired from service if you sell the property, abandon the property, or convert the property to personal use. Depreciation will reduce the property owner's basis in the property and will be subject to a recapture when the property is sold, unless the property owner enters into a 1031 exchange. However, even if the property owner does not enter into a 1031 exchange when the property is sold, capital gain tax rates are typically lower than ordinary income tax rates. In addition, the deferral during the ownership period has material benefits because of the time value of money. The IRS allows residential rental property to be depreciated under straight-line depreciation at a rate of approximately 3.636% each year for 27.5 years. Commercial is depreciated at a rate of approximately 2.564% per year for 39 years. Cost segregation is a commonly used strategic tax planning tool that allows property owners who have constructed, purchased, expanded, or remodeled any kind of real estate to accelerate depreciation deductions, thus deferring federal and state income taxes and increasing cash flow. When a property is purchased, not only does it include a building structure, but it also includes all of its interior and exterior components. On average, 20% to 40% of those components fall into tax categories that can be categorized and written off much quicker than the building structure. A cost segregation study dissects the construction cost and purchase price of the property that would otherwise be depreciated over 27.5 or 39 years under straight-line depreciation. The primary goal of a cost segregation study is to identify all property-related costs that can be depreciated over 5, 7, and 15 years. The IRS holds different timelines for how long a building component's lifetime will be. Cost segregation studies in real estate can reclassify which IRS category a building component falls into. Investors can accelerate the depreciation of the building's components, thus speed up the depreciation expense amount. As your expenses increase, the more you can offset your taxable income. These are generally broken down into 4 categories. Number 1, land. The land cannot be expensed. Number 2, personal property. Renovations such as flooring, fixtures, electrical outlets, and furniture, which can be expensed over 5 or 7 years. Number 3, exterior improvements. Renovations such as parking lots, fencing, etc. can be expensed over 15 years. Number 4, the building. Can be expensed over 27.5 or 39 years depending on the type of asset. In most cases, engineering firms generally complete cost segregation studies, as studies involve a physical inspection of the real property as well as the reclassification of various physical aspects of a building. Bonus depreciation is a powerful tool for real estate investors, allowing them to front-load a significant part of the depreciation. Using bonus depreciation, you can take a huge tax deduction in the first year. Before the implementation of the Jobs Act, the IRS allowed real estate investors to claim up to 50% of their depreciation in the first year. Under the new laws, effective since 2018, you may take 100% bonus depreciation on qualified property, both acquired and placed in service after September 27, 2017, and before January 1, 2023. Full bonus depreciation is phased down by 20% each year for property placed in service after December 31, 2022, and before January 1, 2027. Under the law, qualified property is defined as tangible property with a recovery period of 20 years or less. Prior to 1986, a taxpayer would generally deduct losses in full against wages and passive income from rental activities, regardless of his or her participation. This gave rise to significant numbers of tax shelters that allowed taxpayers to deduct losses against wages and investment income. The Tax Reform Act of 1986 added IRC Section 469, which greatly limits the taxpayer's ability to deduct losses from rental activity in which he or she does not materially participate against wages. The IRS puts real estate investors into three categories for tax purposes. Number 1, passive investor. This is the default. Rental income is generally considered passive income. A passive real estate investor can only deduct passive losses against passive income. Number 2, active investor. This category allows you to deduct an additional $25,000 of your real estate losses against your ordinary income, but this deduction phases out when your adjusted gross income, AGI, moves past $100,000 as a single individual or at $150,000 for a married couple filing jointly. Getting active investor status is easy. You just need to be involved in making decisions about your real estate investment. Number 3, the real estate professional. Real estate professional status is a powerful tax tool for high-income W-2 investors. It can help significantly bring down your tax exposure. If you are able to qualify as a real estate professional, you may be able to reduce your taxable W-2 income by writing off significant passive losses, including depreciation, from real estate activities. For the most part, rental real estate is generally classified as a passive activity. Thus, depreciation or other deductions on rental real estate assets typically can only be offset against passive income, even if you materially participated in the management, acquisition, repair, development, or other activities related to the rental real estate. However, there is an exception to this general rule. If you qualify as a real estate professional, your rental real estate activities in which you materially participated may be classified as active activities. In this situation, depreciation or other deductions on rental real estate can be offset against active income. If the two spouses file a joint tax return, both spouses do not have to qualify as real estate professionals to receive the benefits. Only one spouse must qualify to offset active gains with passive losses on a married filing jointly return. This is commonly done when one spouse is a high-income earner and the other works on real estate portfolio. In addition to other criteria, the two general rules to qualify as a real estate professional are: 1. More than half of the personal services you performed in all trades or businesses during the tax year were performed in real property trades or businesses in which you materially participated. 2. You performed more than 750 hours of services during the tax year in real property trades or businesses in which you materially participated. You do not need any specific qualifications or license to qualify for real estate professional status. A real property trade or business is a trade or business that does any of the following with real property. Real property development, which is a trade or business that includes the maintenance or improvement of raw land to make it suitable for subdivision, further development, or construction of residential or commercial buildings. Constructs or reconstructs it. Acquires it, converts it, rents or leases it, operates or manages it, brokers it. Short-term rentals can be another exception to the general rule that rental income is a passive income. Under certain circumstances, the rental activity can be characterized as a trade or business activity. To qualify, the owner must materially participate in the running of the trade or business, and the average customer must use the rental for 7 days or less, or for 30 days or less if the owner provides significant personal services. The thought here is the activity is more like a trade or business as opposed to simply engaging in passive rental activity. In this situation, depreciation or other deductions on rental real estate can be offset against active income. Just like having real estate professional status, this can be an especially favorable situation for high-income W-2 income earners. However, you will still need to show that you are materially participating in your short-term rentals. Because many of these activities have a management company and may not be near the taxpayer's residence, showing you materially participate may be difficult. However, if you self-manage, these activities can be labor-intensive and easy to qualify. Below are the 3 most commonly used ways to qualify. 1. You participate in the activity for over 500 hours during the year. 2. Your activity substantially makes up all of the participation in that activity. 3. You participate in over 100 hours during the tax year and your activity is not less than any other person's. Material participation can include such tasks as staging, painting the property, managing the property, dealing with guests, repairs, cleaning, restocking, etc. It is extremely important that you document the activities that you perform during the year in a logbook in case you're requested to prove the amount of time and nature of the activities you perform during the year to qualify as a real estate professional or take advantage of the short-term rental deduction as a business activity. A tax-deferred exchange, as defined in Section 1031 of the Internal Revenue Code, is a common way to defer paying capital gains tax on real estate that has appreciated. The taxable capital gain is generally due to the appreciation in value of the real estate being sold and the amount of depreciation taken over a period of time on the property. When using a 1031 exchange, the investor benefits from a tax deferral, allowing the investor to roll the capital gains tax you would have paid into the purchase of a new property. The general rules for a forward 1031 exchange require the following components. The relinquished and replacement property must be like-kind property held for investment. To completely defer the capital gains tax, the replacement property should be of equal or greater value to the property sold. The vesting of the replacement property must match the vesting of the relinquished property, subject to some exceptions. The exchanger must enter into an exchange agreement with a qualified intermediary where the exchanger assigns the exchanger's rights in the contract of sale to the qualified intermediary. Language allowing for the assignment of the contract to the qualified intermediary must be included in the contract of sale. At closing, the proceeds of the sale for the exchange property sold are wired to the qualified intermediary to hold in escrow until the replacement property is purchased. The exchanger must identify a replacement property for the asset sold within 45 days of the date the exchanger closed on the sale of the relinquished property. This is called the identification period. The exchanger must acquire all replacement properties within the earlier of 180 days after the sale of the relinquished property or the tax filing deadline, including extensions, for the year of the sale of the relinquished property. The time periods for the 45-day identification period and the 180-day exchange period are very strict and typically cannot be extended even if the 45th day or 180th day falls on a Saturday, Sunday, or legal holiday. At closing, the qualified intermediary will wire the funds being held in escrow to the sellers of the replacement property being purchased by the exchanger. Thanks for watching, and if you're looking to invest in real estate in the New York area, give us a call. Our contact information is down below.